right into it. When it comes to navigating the crisis, I think there are several avenues that we have been seeing national oil companies around the world explore these days. And I'm going to touch upon all these different ones throughout my presentation. But just to sum it up, what we have been seeing for the past 2-3 months is obviously an increased willingness coming from NOCs and IOCs as well to try to formulate sustainable strategies to weather the pandemic. Obviously, digital transformation has become more important than ever before. We have seen digitalization, taking a very important space after the oil bust and the crisis in 14 and 15. The current crisis has only prompted NOCs even more to invest into digitalization, and obviously all the companies, we are all working in a remote environment. We're going to talk about the steps taken by NOCs, to remain competitive, drive efficiency. So I think keywords such as efficiency, sustainability are at the very top of NOC's agenda these days. And then finally, we're going to touch upon value creation, enhancing local content, how national oil companies and governments are really looking inward to establish domestic manufacturing capabilities and embrace local training in light of disruptions to global value chain. With that, let's just take a look at the importance of NOCs today. I mean, if you look at the world globally, even if you are considering the past decade, we have seen that state-owned enterprises, and I'm talking about all state-owned enterprises, not only oil and gas ones, their assets are worth around $45 trillion, so equivalent to half of the global GDP. Now, obviously, national oil companies around the world control roughly around $3 trillion in oil and gas assets. In comparison, the value controlled by IOCs, there is obviously a massive difference that you can see there. And that reflects the importance of these companies to state budgets, to economies, and subsequently, that obviously reflects how severe the impact of the current crisis is on NOCs at the moment. Now, we do believe that national oil companies, regardless what's going to happen, are going to stay very important and crucial players in the global oil and gas industry. At the moment, they account for around 58% of global reserves and around 56-57% of production. When it comes to NOCs, people often refer to them as oil and gas behemoth, giant companies. They dominate energy production in some of the world's most oil-rich countries, including, of course, Iran, Mexico, Saudi, or Venezuela. And based on our discussions with some of them, and even the ones that have been recently created in new oil provinces, I guess it's fair to say that many of the NOCs are probably poorly understood because of the uneven financial reporting practices these days. And the NOC governance has often been treated as a niche issue in public finance literature. Some NOCs like Rosneft in Russia are highly leveraged, of course. However, excessive debt can create significant risks for many of the oil-dependent economies, especially during this period of downturn and uncertainty. So the takeaway is that in countries where dominant NOCs are too big to fail, the government may ultimately be on the hook of the debts that the NOCs or the NOC has incurred. If we just look at Mexico, I think that's a good example. Mexico's Pemex had $100 billion in debt on its balance sheet by the end of 2018, forcing the Mexican government to take important steps and dip into public coffers to bail out the company. Once again, that only reflects how severe the impact on these companies and economies can be going forward. Now, what we do know is that national companies will be and are already under significant and additional pressure due to the important role as contribution to national budgets and the government's societal needs. For NOCs not blessed with the lowest cost resources, and the pressure for fundamental change will be very intense. This next slide focuses on, again, the potential impact of the current crisis of NOCs only in the GCC, and I try to focus on the GCC region because it's fair to say that national oil companies in that region, Kuwait, Saudi, Oman, UAE as well, they have always taken a culture of efficiency. So it's very interesting to see how the current downturn is affecting the activities. So if we jump back a couple of months ago when the crisis hit the industry, at that point, and that was possibly the worst case scenario, if oil prices remained at $20 per barrel, estimations and forecasts showed that GCC governments could have lost up to 500 million or more than $500 million a day in state revenue. Now, obviously, in the meantime, we have reached that sort of psychological barrier of $40 per barrel, and hopefully we're going to be seeing increased oil prices. But it's obvious that this low oil price environment has really required all states of Gulf states, and of course all the nations on the African continent as well, to tighten their belts. We saw the IMF warning some of the GCC countries that, and that was prior to crisis, that by 2013, 2035, they could easily become net debtors to the rest of the world. And that focus was made on an oil price of $55 per barrel. So imagine that at $30 or $40 per barrel, that timeline will absolutely shorten. So we are seeing countries like Oman, where the debt is so heavily discounted that it may soon slip into the distressed debt category. And again, it's going to be interesting to see, what sort of strategies these national oil companies will be taking to mitigate the challenges caused by the current crisis. Now, when it comes to the adapting to the new normal, I mean, we have long been talking about it, and I think there is no golden rule as to what sort of actions companies will be taking. What we know is that every single company has its own way of taking actions, and I think the crisis was particularly sensitive and painful at the beginning of the year, because 2020 really started with a cautious amount of optimism, increased activity. We have seen that confidence had really returned to the industry with improved performance. We have seen in 2019 the discovery of several billion barrel plays. Explorers were keenly aware of the challenges ahead, also to take risks. So at that point, at the beginning of the year, investability, capital efficiency, the risks of exploring deep water, and of course, societal pressure to move towards energy transition were some of the most important challenges. At that point, these companies were not dealing with a lower price environment and the pandemic. So it's fair to say, that it's a new type of crisis. The pandemic has really been taking a beating on the energy sector as a whole. Global investment in the energy sector has already decreased significantly, and it's expected to plunge 20% in 2020, or by almost $400 billion. We have seen the worldwide rig count go down from 2,100, 2,200 back in May 2019 to around 1,170 in May 2020. So that's obviously a massive drop, and the consensus among industry experts is that exploration works of national oil companies will be hit by some of the deepest cuts going forward. So we may just be seeing one of the biggest, if not the biggest, oil market crash in history, while the industry was really transitioning to a low carbon energy future. So there are some interesting trends to see there eventually. People talked a lot about demand destruction. I think it's interesting to touch upon the situation of US share producers, purely because they had such a productive and value-driven role after the oil bust in 14 and 15. At the moment, all of them have pretty much entered into a survival mode, and they cut the 2020 capex by up to 30% or by $85 billion in a bid to protect their balance sheets, maintain shareholder payouts, and eventually preserve liquidity. Back in time, it was very interesting to see that some of these share producers were able to outlast an earlier Saudi price war by lowering their costs by up to 50%. The big question right now, and that's a question for both NOCs, IOCs, and the services societies as well, is that whether there is more or deeper or significant room to accommodate reductions in rates. So that sort of move of share producers that really helped the United States to increase its production by almost 4 million barrels per day, that seemed to have come to an end. And unfortunately, it's a completely different ballgame this time around for all companies, including independents, IOCs, and of course, on top, national oil companies. So at the moment, really just to draw some conclusions, I think we are facing a lack of adequate predictions. Most companies, and industry players, they have difficulties understanding what's going to come next. A lot of companies that we have been speaking with expect that the crisis will go on and operations will keep being disrupted up until 2022. We at the Energy Year, we do not subscribe to an idea that this crisis, this downturn will be over anytime soon. And unfortunately, I think we believe that the crisis will change the industry we know and the industry's ecosystem that we know permanently. However, the prospects for NOCs and for the entire industry as a whole can really become much more positive in the long term. The crisis has really shaped up the industry, and that's a good thing. So many companies were forced to go on an unforeseen diet, step out of their comfort zone, and eventually many of them, those who do not go under, they will be in a much better shape, in a leaner shape, to take on new challenges and capture value once the pandemic has settled and oil prices have increased once again. Two key themes that we expect will emerge from this current period are definitely technology. So digitalization is obviously part of that, and operational efficiency. Now, developing sustainable strategies to weather the pandemic, that's an interesting one because the feedback varies from one company to another. Different NOCs react in different ways. I guess the silver lining in the current situation is that despite these difficult times and troubled and uncertain times, new and better barrels of oil equivalent will continue over the next 20 years. So for NOCs, going after exploration works, in order for them to prosper, those barrels that they are going after will have to be low in costs and in emissions. So instead of purely focusing on reducing the unit cost per production, which is definitely the focus of most national oil companies around the world these days, they really have to become open to the idea of cost optimization. So what we are seeing eventually as a trend is that most NOCs are quickly shifting away from a focus on volume towards the realization of value. So eventually they are trying to do more with less. We expect many NOCs will be riding the path of trying to become sort of like a commercial NOC, so fully embrace the need to embark on a journey of capital transformation. And eventually by implementing these changes and and changes that IOCs are going after as well, we believe they will be able to maximize the margins and increase capital efficiency. So that's again going to be an exciting thing to watch in the next couple of months. Now, it's also fair to say that we have seen a wide range of reactions when it comes to these massive state-owned oil and gas companies dealing with the current crisis. There have been several success and failure factors in crisis response strategies. It's quite surprising that some of the NOCs, I believe, are still living in some sort of denial move. So some companies have been caught completely unawares of their surroundings. And at the beginning of the crisis, 2 or 3 months ago, 4 months ago, they pretended that the crisis would be over anytime soon, and the industry would adjust itself to the new reality. Unfortunately, these companies will have significant issues going forward. Some NOCs are taking the path to retrench. So basically, they have started to reduce costs from day one and spending in response to the difficulties. They are assuming that the fundamentals of the energy industry will quickly reassert themselves. A higher sort of category where we see pretty much all the NOCs throughout the GCC region, many of them from Europe and some of them from the African continent as well. They prefer to play it out in a reactive way. So they are already exploring new avenues to integrate along with the value chain. They are localizing material supply chains, and supporting capabilities through on-demand manufacturing. They are stepping up their research and development capabilities eventually. They are taking new digitalization initiatives, and they will be dealing with the challenges as they arise on a daily basis, since it's extremely hard for them to make predictions. And then there is that category that we also call repower, which is very slim. Only a couple of and a handful number of companies belong here. Equinor would be one of them. Petrobras, surprisingly enough, is the other one, and they pretty much acting as they had as if they had the situation figured out from day one. So they have been implementing measures that they had been preparing for quite some time. No matter which approach companies will be taking at this point of time, flexibility will be instrumental. So changing that approach from one day to another is crucial to survival. And eventually, all that these companies are preparing for is really to try to capture value and to build up additional capabilities for when the industry readjusts itself. Hopefully, it's going to be in Q1 2021 to capitalize on new opportunities. Now, when it comes to embracing these new opportunities and identifying the drivers, the key drivers for post-crisis growth, there are a couple of things that NOCs are already doing. One, as I have mentioned, is about unleashing big data potential, going up to digitalization and looking at the big data market. That's certainly something that's very high on the top of the agenda of NOCs, IOCs, and the services society as well. So that sort of movement hasn't really stopped. Bringing the ecosystem into play, that's an interesting one. We have been seeing many NOCs, reaching out to services companies, IOCs as well, trying to bring them into the ecosystem, try to establish productive, value-driven collaboration. We have seen some of the top full-stream services companies around the world at the end of 2019 and 2020 establishing local manufacturing centers in Nigeria, in Saudi, in Oman, in an effort to enhance local capabilities in collaboration with state-owned companies. So that was again an interesting trend to see, and we expect that will continue. Diversification into new markets, that's also a strategy that some NOCs have taken as of last year. However, we are seeing the focus of the NOCs shifting going forward. So in the short term, that sort of trend of national oil companies expanding internationally may as well be reversing. and they will probably be prioritizing domestic activity. That's purely because of that mandate, their mandate to increase the country's resilience, the government's resilience to cope with the current challenges, and of course contribute to the national budget. Super majors and NOCs eventually in 2019 participated in about 80% of high impact wells drilled. That's quite a high ratio. Most NOCs consistently spent in between 12 to 35% of the upstream budget on exploration, as opposed to 8% that's being spent by IOCs. So, you know, these strong mandates to contribute to governments will also prompt NOCs to continue with exploration works. Eventually, budgets will be reduced, but won't stop in the entirety. Building new local capabilities, that's one item that we're gonna touch upon. So enhancing local content is, as I mentioned earlier, will be key. And most importantly, one sort of push that we are seeing when it comes to embracing new opportunities is, of course, investments into environmental, social, and governance funds, which is something that have started throughout 2019. So that's part of that sort of transition to low carbon energy. That may as well mean that oil is losing its favor going forward. Natural gas is obviously becoming much more popular, and discoveries with break-even costs and low emissions will have premium value in the future. So eventually, many of the NOCs will be assessing emissions before investing as part of their commitment to a net zero carbon economy. Now, two factors that will be determining, you know, whichever opportunities these NOCs will be embracing are addressed constrained domestic resources and eventually limited financial strength, which are obviously very significant challenges. We expect that originally added resources will contribute to around 50 and 70% of NOC's production in the next decade. But if you look at some of the national oil companies in Asia or Southeast Asia, so Petronas or PTTEP or China National Oil Company, they are striving to protect their exploration plans as much as possible, as opposed to Gazprom and Rosneft in Russia that have very long reserve lives, and they feel that the pressure to rush their exploration plans is not that strong eventually. So exploration budget cuts, very necessary today, as I mentioned, and they will impact a company's future growth and sustainability. But given how important exploration is for NOCs and the growing share of global new discoveries, these budget cuts are likely to become short-term measures rather than long-term ones. So that's at least a positive takeaway, and we expect exploration works to continue. Embracing digitalization, embracing digital transformation is, of course, one that's extremely important amongst all the strategies that these companies are taking. Big data has become a phenomenon that has gained crucial importance after the oil bust in 14 and 15. If you look at the global big data market in a pre-crisis level, it was expected to grow at a compound annual growth rate of over 15% up to 2023. So basically by $4 billion. Now, we may not see that sort of growth, but we will be seeing more and more NOCs investing into digitalization and whatever comes with it. And why? You find that oil prices and demand are changing these days more rapidly than any major's ability to rerun their production planning. So eventually the current market is changing faster than the supplier's ability to change. So eventually all the national oil companies are running after data. They're trying to collect data. They are trying to synchronize data across all the different subsidiaries. And that's the basis and that's the main idea behind digital transformation. They need to have a good end-to-end visibility across all the different subsidiaries that they are operating, so that eventually they're gonna be in a much better situation, a much better place to use that data to optimize costs. However, one of the key challenges that we are seeing here is that the learning curve for big data or digitalization is pretty long. So those companies who have started to embrace digitalization after the crisis in 14 and 15, they are surely in a much better place right now to cope with the challenges. Many of them are still in a mid-cycle in terms of the implementation, which means that the current crisis can easily destroy the progress that they have made. While some other NOCs, typically, NOCs across the GCC region like ADNOC or Aramco or QP, they have been embracing big data for the past decade or decade and a half. And they are ahead of that sort of maturity curve already, which means they are in a much better spot at the moment. They are at the late cycle stage on artificial intelligence, on IOL, Internet of Things, big data, cutting edge technologies. So eventually they are much better situated at the moment to cope with the challenges and of course capture value. One particular example would be perhaps petroleum development, Oman, that has long been embracing digitalization and innovation. That's a company that really expects to have 1/4, so 25% of their production coming from enhanced oil recovery by 2025. But if we just take the Panorama Digital Command Center, which has been talked a lot about over the past 2 years, it was introduced by ADNOC eventually in 2018, and it allows ADNOC to run optimization program. And it has generated over $1 billion in business value and allowed the state-owned company to maintain operations and respond swiftly to the current market dynamics through the coronavirus pandemic. This Panorama Digital Command Center is a good example to follow. Obviously, it does require very heavy investments. But it does synchronize, operating costs, transport costs. It gives you a great idea about your costs of stopping and restarting your production, oil quality, and all the other factors are included in it. So we expect to see many other national oil companies heavily investing going forward in similar platforms that will eventually allow them to optimize costs, and that's the whole objective behind it. Digitalization, I think it's widely accepted that it's a phenomenon that's already improving the safety, the productivity, the accessibility, and eventually the sustainability of energy systems around the world. It's changing markets, it's changing us, it helps us to adapt to a new reality. And thanks to digitalization, new business models are emerging every day. The big question remains out there is whether digitalization can positively contribute the nature of employment. And we truly believe that yes, it can, and we have seen various examples of that. So digitalization, digital transformation, that won't stop. We believe we haven't exhausted our full potential, so there are going to be new items to embrace and new discoveries that will be made. This next slide, I was going to touch upon quickly about the importance of NOCs taking measured investments going forward while trying to raise capital and and of course drive efficiency. There are several ways of doing that, but in this today's climate, options are limited for many NOCs. So they are either trying to draw down on state reserves, which is obviously not an option for governments, or they are trying to sell assets, eventually consider partial privatization. Throughout 2019 and early 2020, we have seen an unprecedented number of governments considering partial privatization or listing of the NOCs to raise capital. And they have been exploring alternative means of funding capital requirements and project financing. So as for access to financing, it will be an interesting trend to watch, I believe. Some investors believe that the world will be changed so indelibly that oil demand will struggle to regain the upwards trajectory that has underpinned the industry for the past couple of decades. So we may as well see the demand to peak earlier with a more rapid shift into renewable energy, which obviously means that privatization will be one thing, but restructurings of NOCs may as well follow. So there will be a growing pressure on the industry to adopt a core fossil fuel business, perhaps even sooner. And of course, the health crisis is also changing the attitudes of people significantly. So eventually, that will possibly roll up to the entire industry as well. If we look at 2019 or even early 2020, I mean, we have seen some of the major NOCs going through some restructurings and IPOs. Saudi Aramco has raised around $10 billion at the end of last year by selling stakes in its pipeline business, and eventually the company is right now using those funds to finance one of the key acquisitions that it has just pulled $70 billion into Sabic, and another $75 billion payouts in dividends. We have seen NOC recently entering into an agreement with some of the world's leading infrastructure investors once again to close gas pipeline assets in its subsidiaries, valued at around $20 billion. Other majors NOCs such as Petram Development Oman, which is not fully owned by the state, but they have recently announced that they are transitioning and changing their name and rebranding into Energy Development Oman, which means that the company is really looking beyond the curve, beyond new horizons. They are expanding into renewables, power generation, and they are eventually becoming a full stream energy company. Why is that important? Because by doing that, they're going to be offering new opportunities for the services society as well, to bring in new capabilities in those areas. Then if you move on, you have seen OQ, a new entity born out from two massive entities in Oman. So Oman Oil Company and OPIC have recently merged. They have synchronized their operations. We are seeing more than 5,800 people coming together, as a result of which they are doubling their current GDP contribution from $10 to $20 billion. And eventually, they are enhancing the development of an integrated hydrocarbon value chain within the country. So that's all part of that sort of push to look inwards. Egypt, a year ago, has decided to put 7 downstream firms, 2 oil services subsidiaries of the state-owned firm EGPC, under the country's privatization plans. Bahrain has started to open up its industry. In Angola, we have been seeing a very ambitious and interesting restructuring campaign that Sonangol has been going through, and the company seems to be set to privatize 30% of the NOC's assets. So they did launch a tender for the sale of stakes in 9 NOC companies in an effort to attract more foreign direct investment. And of course, there are obviously players out there who are sitting on larger cash reserves, but that's mostly because of their ultra low upstream production costs. So upstream production costs. Qatar would be a great example of that. Despite the current situation, we have seen Qatar Petroleum running a very aggressive investment campaign. So drilling at the North Field has started in the midst of the pandemic. So the country is really pushing forward with its plans to increase LNG output. In tandem with that, Qatar Petroleum has invested in new blocks in Mexico, in East Africa, and signed a $20 billion order for 100 LNG ships eventually that will be delivered to the company. So we have been seeing some very interesting and very strategic moves. I guess it's important to mention that these privatizations and partial sales of assets in national companies won't stop. We expect to see even more and more. If we move to the areas of East Africa or even West Africa, geographically speaking, major oil and gas discoveries have opened new exploration plays in these regions. So East Africa and offshore West Africa have started to attract a lot of FDI over the past couple of years. And in light of that, African governments really wanted to ensure greater national participation in the upstream petroleum sector. So many have started creating new NOCs. Eventually, in the Americas, Guyana would be a great example of that. And many of these nations in Africa have started to restructure their current NOCs to take on greater operational roles. The issue that we have seen here, and this issue comes up even more and more during the current climate, is that many of these NOCs in these emerging producer countries are struggling to establish themselves, and the crisis caught them at this very stage. The key issue that they face eventually is a lack of clarity around the cost of fulfilling their mandate. Too often they have been given ambitious mandates, in particular to become an upstream operators too early on, and these mandates have not necessarily been in line with the country's existing geological, financial, and even human resources. And the result is that the NOC stewardship of oil and gas reserves may be suboptimal at this point of time, and risks the vision of creating national champions that drive broader development agendas, and therefore these agendas are not being met at the moment. So the potential is there in these developing nations. If you just look at some of the governments, that are considered new, and near producers, investors have been looking at places like Ghana, Uganda, and Mozambique, companies or countries that have recently made discoveries. Kenya, of course, Liberia, Tanzania are amongst them. And then we have some very interesting upcoming provinces that are already exploring. Namibia and the Seychelles are definitely worth mentioning. So across Africa, governments are creating new NOCs, as I have mentioned. Natoil in Uganda has been created a couple of years ago, and it has been set up to ensure national participation in newly discovered petroleum resources. Again, as I have mentioned, overly ambitious national priorities sometimes can lead governments to test the NOCs with roles that are above their capabilities at the moment. And it can easily lead to confusing and sometimes conflicting roles in this sector. So without an agreed upon mandate, some of the NOCs lack the support in government to access public funds. And that's why the pressure that's on them at the moment with the current crisis is greater than ever before. However, we do expect interest, as high as possible coming from foreign direct investors looking at East Africa and offshore West Africa as well. Needless to say that many of these companies won't be willing to look at frontier exploration opportunities and take higher risks in a post-pandemic environment. But we will be eventually seeing greenfield investments in the next couple of years once again. Moving forward, and I wanted to touch upon quickly on the importance of mitigating supply chain disruptions. That's obviously a key area for national oil companies, and we all know that supply chain resiliency has taken a significant hit too, and proactive companies are likely to look at diversifying suppliers and other third-party risks. You know, with the oil prices being at historic lows and with the COVID-19 supply chain disruptions, the time has really become for most of the countries and most of the companies to look at evaluating the supply chains, come up and develop new procurement strategies, sourcing techniques, and costs. So all petroleum provinces and governments are really discussing the importance of looking inwards. They are trying to rethink their supply chain strategies, and eventually they will be benefiting from these discussions going forward. We have seen most NOCs coming out, you know, asking the services society and the suppliers to try to accommodate more cost reductions. And there is the big question still, whether services players can do that. We know that they had been capable of doing that after the crisis in 14 and 15. However, the prices since then have not been readjusted. So they have been working with those reduced prices. And it's doubtful whether they're going to be able to accommodate more room for cost reductions. However, there is definitely room for the industry to come together and have productive discussions about where and how costs can be optimized instead of just looking at reducing the unit costs. Based on the discussions that we have conducted with many of our clients, what they are trying to do, they are looking at different strategies and approaches as to synergizing the current and existing supply channels. So, and that's very much true for all the NOCs. So they are either looking at supply chain mapping, which involve a thorough understanding of suppliers, including their global sites. And I'm obviously referring to suppliers in China as well, in the cities where the pandemic was born. If you look at Wuhan, we have more than 5 million companies globally with tier 1 or tier 2 or tier 3 suppliers. So some of these NOCs under supply chain mapping, they are trying to understand the major spend categories. You know, they are trying to build custom fit procurement processes. They are trying to set up new local sites or get to know those local sites that they have never seen before. Eventually, other than getting to know the tier 1 suppliers, a sort of push and willingness that we have seen from national oil companies is to reach out and try to get to know a little bit more the assets, the operations, and eventually the environment where the tier 2 and tier 3 suppliers have been operating, you know, and what sort of efficiencies and contingency plans they have in place. So really trying to get that greater visibility into an extended supplier network, that's going to become more important than ever before, eventually. And we have seen that there has been a paradigm shift in the way oil and gas companies have started to embrace e-procurement, and they have shown interest in e-procurement systems, you know, to select their relevant suppliers and really focus on alignment and really focus on sustainability throughout the entire value chain. So these are some of the themes that will continue to emerge in a post-crisis environment as well. Enhancing the benefits of local content and structural transformation is again probably the hottest area that many companies are focusing on at the moment. So COVID-19 and the current oil price environment has really prompted and demands a new thinking, you know, on local content in oil and gas. I believe that COVID-19 has really challenged our model for sourcing goods and labor in global supply chains. And it's also forcing us to come up, and it's forcing all the national oil companies to come up with new solutions on how to safeguard the local supply of goods and services. So over the past decade and a half, I believe, if you look at the African continent, we have seen many of the national oil companies steadily increasing the push for new localization in the sourcing of goods, services, labor, training, and so on and so on. And the current pandemic risks must now be really factored into the way we are enhancing local content, and into the way we are dealing with the upfront cost of investing in local supply chains at the early stages of investment assessment. So of course there are some really good examples out there. In country value, in Oman, I think it's a widely respected and acknowledged theme. It's a very important program that the Sultanate of Oman has introduced, and that has clearly had some very important benefits. ICTWA in Saudi Arabia is again another one that we have been talking about a lot. Nigeria's local content bill, I believe, is the one to look at on the African continent. The institution of NCDMB has celebrated its 10-year anniversary recently in the midst of the pandemic. And because of this push in Nigeria, I'm just going to grab that as an example for other countries, because we have seen many other producers on the African continent trying to do things in the Nigerian way, where the local content journey, as I mentioned, started really a decade ago, and it has really come in very handy for the country to weather the pandemic. Nigeria has been able to use this past decade to develop a lot of Nigerian suppliers, eventually build plenty of new training centers, new capabilities and capacities across the country's oil and gas value chain, and train Nigerian engineers to do most of the works that had been done by foreigners in the past. So that, to me, is a very good example to look at. In the GCC, there have been a lot of questions in the Middle East overall over the role of local workforce, and most governments have really set off ambitious objectives to embracing country value. We know the important role that expatriate workforce has taken up in these places, and unfortunately, we don't expect that these countries can quickly transition into an oil and gas industry that's fully dependent on local workforce. So expatriate workforce in the Middle East will stay very, very relevant going forward. Over the past decade, the contribution of South Asian workers has been a major factor in the Gulf's rise, of course, and its economic success. So basically, there are difficulties out there for national oil companies in terms of fulfilling their national obligations, and they really have to balance that with the commercial decision making. There will be plenty of challenges along the way, and I'm sure that we're going to be touching upon many of these later in our webinar as well. So I look forward to discussing that. And I just would like to draw a couple of conclusions, because that really takes me to my very last slide as to what actions we have seen national oil companies taking, and eventually what we expect to see going forward. So yes, we do expect to see continued uncertainty once the global economy and the global oil and gas industry stabilizes. There is no indication that growth won't return, as the world still needs oil and gas to sustain development and drive prosperity in the developing world. So not to mention meeting the needs of an estimated 2 billion people who will join the global population eventually by 2050. So I do believe that the demand side will be there, although there is still a question whether that demand will be for oil we're going to be seeing an additional push towards, low carbon transition, net zero carbon economy. So sustainability, as I mentioned, and energy efficiency will have very important roles. We expect to see opportunistic asset purchases and a great deal of consolidation, whether that be through the forms of joint ventures or even mergers, or some of the privatization moves that I already touched upon earlier. National oil companies won't stop investing. They will go through a path of measured investments. They are trying to build up, massive cash reserves, so they're going to be able to capitalize on opportunities in a post-pandemic environment. And eventually we're going to be seeing a holistic approach to ensure all aspects of sustainability that are obviously being covered and incorporated into the new environmental, social, and governance strategies of IOCs. But as I did talk about it earlier, I think that sort of model may as well be adopted by NOCs as well. So going after sort of like commercializing the activity